So in just, I think it was just 8 weeks, the stock market conjured $50 trillion in new collateral completely out of thin air.
Yeah, it's almost impossible to actually visualize that number.
Right. To put that staggering number in perspective for you, if you look at the entire COVID era quantitative easing from the Fed, that was less than $10 trillion.
Exactly.
And then all the massive fiscal spending packages combined, that was also around 10 trillion.
Yeah.
And yet, a simple 20% market rally just spawned 5 times that amount in collateral value, just sitting there beneath the global financial system.
Which fundamentally changes the math of how capital operates. I
Hmm.
mean, when you are dealing with a $50 trillion expansion in collateral in mere weeks,
Yeah.
you're no longer just analyzing corporate earnings. You're
Yeah.
you're analyzing the structural integrity of the entire system.
Right. And welcome to today's deep dive, where our mission is to basically cut through the daily financial headlines and unpack this incredibly dense stack of macro market analysis we've got in front of us.
It is dense,
Yeah.
but it's so important right now.
Oh, absolutely. We are looking strictly at the mechanics driving global capital today. So,
Yeah.
volatility signals, cross asset correlations, specific options flows. We really want to decode what implied volatility is actually telling us about expected market moves, the reality of the AI capital expenditure supercycle, and how hidden leverage is just quietly blowing up portfolios right behind the scenes.
Yeah. And to do that, we really have to step away from just looking at fundamental valuations and start examining what we call the behavioral layer of the market.
The behavioral layer.
Yeah, because fundamentals are important, obviously, but they only matter until extreme leverage and volatility basically break the system.
Right.
And right now, the system is under this incredible pressure from a totally new set of rules driven by the sheer scale of the collateral you just mentioned.
So let's trace the mechanics of this collateral machine then, because going through our sources, it's clear this is the absolute ground floor for understanding why volatility signals are acting so erratically lately.
Definitely.
So we are looking at a global equity market sitting at roughly $300 trillion. And that's divided into about 150 trillion in public equities and another 150 trillion in private.
And the linkage there is the critical mechanism you have to understand.
Right.
Because private equity valuations, they don't just exist in a vacuum, right? They run directly off the public market numbers.
They mark to market based on public comparables.
Exactly. So when we talk about a $300 trillion ecosystem, we are talking about an interconnected entity that has, in a very literal mathematical sense, become too big to fail.
Because of all the leverage stacked on top of it.
Yep.
Like a 20% market drop doesn't just mean your retirement portfolio loses some unrealized gains. It means $50 trillion of collateral just vanishes from bank balance sheets and margin accounts.
Which is precisely the problem. And because the entire global financial system is built on borrowing against that collateral, the evaporation of $50 trillion would trigger a systemic margin call it would be far worse than the 2008 financial crisis.
Wow.
Yeah, and this mathematical reality is forcing a massive shift in how governments actually interact with the market. They're realizing they have to actively manage this collateral to prevent a collapse.
Yeah, and our sources are describing this shift as a new industrial policy forming. One analyst actually went so far as to call it socialism with American
Right,
characteristics.
which is quite the phrase.
It is. And just to be clear for you listening, we are strictly reporting the structural analysis here. We are not taking a political stance on this.
Of course not.
But the theory is that the U.S. administration might eventually have to step in and buy equities directly to manage this dynamic.
Right, and the structural comparison the sources make is to Norway.
Okay. The sovereign wealth fund.
Exactly. Norway funds a massive portion of its social services through a $3 trillion sovereign wealth fund. And the idea sort of bubbling up in macro circles right now is that the U.S. might eventually build its own massive sovereign wealth fund.
But not funded with oil, right?
No, exactly. Instead of funding it with oil revenues like Norway, the U.S. would be doing it to manage its explosive national debt and to kind of short-circuit rising domestic populism by ensuring the market and the collateral it supports never truly collapses.
I mean, I have to push back on this, though. If you're looking at this from a structural standpoint, if the government is practically forced to backstop a $50 trillion collateral machine just to protect the U.S. dollar status as the global reserve currency.
What they call its exorbitant privilege.
Right, the exorbitant privilege.
Yeah.
Doesn't that completely break traditional volatility models? I mean, if the market players know the house cannot afford to let the market crash, the whole concept of risk is fundamentally distorted, isn't it?
It is completely distorted. It creates a staggering moral hazard, and you're hitting on the exact reason volatility models are breaking down right now.
Yeah.
Because there's this implicit assumption of a government backstop, market participants are getting dangerously comfortable with leverage.
Right.
The behavioral logic is basically, hey, if the downside is structurally protected by the state, I should borrow as much as humanly possible to amplify my upside.
Right. I literally can't lose.
Exactly. But this false sense of security leads directly into the massive deleveraging events that we are seeing spike market volatility today.
Which perfectly explains those spectacular blowups we've seen in the last few weeks. So let's actually dig into the anatomy of the recent hedge fund collapse that was detailed in the sources, because I think it perfectly illustrates this distortion.
It really does.
So this fund manager was long on AI infrastructure stocks, so, the companies building the physical hardware, and they were short on software companies.
Right.
And then they applied 3.5 times leverage to this portfolio of highly volatile stocks.
Which is just wild.
Mm-hmm.
And what happened is the manager fell into what we call a correlation trap.
Okay, explain that.
So on paper, or, perhaps looking at a 5-year historical beta, he thought he was hedged. He assumed that infrastructure and software were negatively correlated, meaning, one went down, the other would go up, balancing the portfolio out.
Right.
But in reality, both of those positions loaded heavily onto a single overriding macroeconomic factor, which was artificial intelligence.
Yeah, I want to visualize this for you, because true negative correlation is like owning a ski hill and a golf course, right?
Right.
One makes money in the winter, the other makes money in the summer. So no matter what season it is, your revenue is smoothed out, your overall volatility is lowered.
Exactly.
But this hedge fund essentially bought an ice cream stand and a sunglasses shop, and they called it a hedge.
Yeah, that's a perfect analogy.
Right, because they both rely on the exact same sunny weather. When it rains, when the AI narrative takes a hit, both businesses lose money at the exact same time.
Yeah, that is the perfect mechanism to explain it, because when the AI factor wobbled recently, both positions moved in tandem against the fund.
Right.
The long infrastructure positions dropped, and the short software positions rallied. So he wasn't hedged at all.
Zero hedge.
Zero. And when you are leveraged 3.5 times on highly volatile assets moving against you simultaneously, I mean, your equity is wiped out in hours.
That's insane. And it feels like it exposes a massive misunderstanding of how leverage actually functions in today's market.
Well, it exposes what should be the golden rule of volatility, which is you cannot mathematically increase leverage and volatility at the same time.
Okay.
You can leverage low volatility assets. Think of traditional government bonds. A 2% move is massive, so institutions leverage them 20-to-1 to generate returns.
Right.
But the higher the inherent volatility of your assets, the lower your leverage must be.
Because high volatility proves the asset is trading on a psychological layer, right?
Yeah.
Not just fundamentals.
Exactly. High volatility in a stock proves that the market is trading it based on behavioral swings and forward-looking narratives, not just its present, fundamental cash flows.
Yeah.
If you try to apply massive fixed leverage to unpredictable behavioral swings, the market's volatility will simply chop your position to pieces and force you to liquidate.
Right. But if extreme leverage is punishing these behavioral trades so badly, where is the smart money actually going to find physical growth? Because this breakdown in correlations isn't just happening in niche hedge fund portfolios.
No, it's everywhere.
Yeah, the sources show us we are seeing massive, totally unusual divergences right now when we cross-reference the bond market with commodities. We are basically seeing a transition from financially driven narratives to physically constrained realities.
Yeah, and the clearest place to see this transition is the yield curve. The bond market is currently flashing warning signals that are totally at odds with certain segments of the equity market.
And the numbers in the stack are stark. Like, the 30-year Treasury yield just blew through its cycle high, hitting 5.19% and then pushing all the way up to 5.28%.
Right.
The 10-year and 20-year yields are surging right behind it. The TLT, the popular long-term Treasury ETF, it's hitting multi-year lows. But the most alarming mechanism here isn't just the nominal rate, it's the real yield. The sources note that real yields on the 5-year Treasury are up 72 basis points since the start of the year.
So let's ground that mechanism for a second for the listener.
Yeah, please.
The real yield is your return after subtracting inflation expectations.
Okay.
So when real yields rise 72 basis points, it means the risk-free return offered by the government is suddenly far more attractive. And traditionally, high real yields act like financial gravity.
Right, pulling everything down.
Exactly. They make corporate borrowing fiercely expensive, and they suck capital away from riskier assets. High real yields traditionally crush non-yielding assets like precious metals because, why hold gold that pays 0 interest when you can get a guaranteed 5% from the U.S. government?
And we are definitely seeing that gravity apply perfectly to certain commodities right now. I mean, silver is having a very hard time breaking through the $60 mark, and gold is struggling heavily at $4,100,
Yep.
which is exactly what traditional cross-asset correlation models predict when real yields spike.
But look at the industrial metals,
Uh-huh.
because that is where the model completely breaks.
Right, because copper is flying over $6.50, aluminum is soaring. They are completely ignoring the macroeconomic gravity of high real yields that are supposed to be holding them down. So how does copper completely detach from the bond market like that?
Because the physical shortage of raw materials is completely overpowering the macroeconomic drag of expensive debt. The cross-asset correlation between bond yields and industrial metals has temporarily broken because we are in the early stages of a massive physical capital expenditure supercycle.
This is the AI data center build-out.
Exactly.
And the earnings data in the sources proves this isn't just a Silicon Valley narrative, right? It is quite literally steel in the ground and copper in the walls.
Oh, yeah.
I mean, Microsoft added 31 new data centers in a single quarter.
Wow.
Yeah, and they added 1 gigawatt of power. Amazon's capex for 2026 is projected to hit an unbelievable $220 billion.
That number is just insane.
It's nuts. And Meta is guiding for 130 to 145 billion in capex. Every major tech CEO on these earnings calls is explicitly stating they physically cannot build supply fast enough to meet demand.
Right, so when you cross-reference Amazon spending $220 billion with copper, defying a 5% 30-year yield, the picture becomes crystal clear. Demand for electricity and the conductive metals required to transmit it is so structural and so immediate that buyers don't even care what the cost of capital is. They have to secure the physical copper regardless of the interest rate.
Okay, so knowing that this AI build-out is a physical reality and that the recent tech sell-off was driven by forced deleveraging events, like our hedge fund example, rather than a fundamental bubble bursting, how are institutional traders actually positioning themselves?
Good question.
Because if we want to move past what people are just saying and look at what they're actually doing, we need to decode the options flow and see what implied volatility reveals about expected market moves.
Yeah, and the derivatives market is the ultimate truth teller because it's where participants have to actually put their capital on the line to back their forecasts.
Put their money where their mouth is.
Exactly. So let's start with interest rates. The effective federal funds rate sits at 3.63%. But if you look at the Fed funds futures, specifically the ZQ contracts, you get a very different story than what the media talking heads are projecting.
Right, because the media narrative has been dominated by talk of rate pauses and impending cuts, right?
Right, but the ZQ contracts are actively trading based on real probability. And the sources show that the April contract for Q1 is currently pricing in 4.85%.
Wow.
Yeah, the futures market is heavily weighing the probability of 1 to 2 rate hikes by year-end.
So they're completely bucking the narrative.
Completely,
Yeah.
because the futures market understands the mechanics we just discussed. They see the $50 trillion collateral machine, the massive government debt issuance required to sustain it, and the inflationary pressure of a $220 billion capex supercycle from just one tech company.
Right.
The options market expects inflation and high borrowing costs to persist, and they are pricing risk accordingly.
So how does that macro reality translate to specific equity options plays? Because the sources highlighted some incredibly targeted flows here.
Yeah, some very specific trades.
Yeah, for instance, someone took a massive long position 21 NQ contracts, which are NASDAQ futures for September. That is a heavy leveraged directional bet that the recent tech sell-off was purely behavioral and is going to snap back violently.
Right, but directional bets are one thing. What is truly fascinating is how the smart money is exploiting implied volatility, which is basically the premium people are willing to pay for insurance against price swings.
And the app Love and Trade is the perfect example of this. The sources detail this strategy of selling $320 put options on AppLovin just before they reported earnings. Now, selling puts right before earnings seems risky, right?
Well, rather than just taking a directional guess on the stock going up, selling these puts was actually a play on volatility crush.
Okay, what does that mean?
So implied volatility was sky high because the broader market was terrified of a tech sell-off. Right. Market participants were paying massive premiums to hedge their downside risk on AppLovin.
But the seller of these puts had a structural advantage by looking at cross-asset correlations, right? Because AppLovin is an advertising technology company. And just days before they reported, Meta reported their earnings.
Exactly.
And Meta showed a 28% increase in ad revenue, a 14% jump in ad impressions, and a 12% increase in the price of their ads.
And the mechanism here is the digital ad auction ecosystem. Because AppLovin relies on the exact same underlying demand environment as Meta, Meta's massive earnings beat acts as a near-perfect leading indicator.
Right.
The fundamental demand for digital advertising wasn't shrinking at all, it was surging.
So the traders selling the AppLovin puts knew that the implied volatility was wildly overpriced. The fear priced into the options market was just a behavioral reaction to the broader tech deleveraging.
Yeah.
And it completely ignored the fundamental reality proven by Meta's earnings. So the seller collects that massive fear premium, knowing the underlying digital ad demand would keep the stock elevated, collapsing the volatility and making those options expire worthless.
Which is just a textbook execution of trading the behavioral layer. You are monetizing the market's irrational fear by anchoring your trade to cross-asset data that proves the underlying fundamentals are actually strong.
And we saw the exact same mechanic with Micron, right?
Oh, yeah.
Micron makes the memory chips critical for AI data centers. Every single tech giant building these facilities acknowledges that memory prices are going to continually rise due to supply constraints.
Right.
Yet, because of broader market hand-wringing and deleveraging fear, Micron stock was beaten down to roughly 5 times forward earnings.
I mean, 5 times forward earnings for a critical supplier in a generational CapEx supercycle is a blatant anomaly.
It makes no sense.
None. The implied volatility on Micron's options was elevated because of the behavioral shock of the broader market sell-off. But the structural reality, the actual physical demand for memory chips, is incredibly robust.
So selling puts there makes total sense.
Exactly. Selling puts on Micron allows a trader to collect a massive premium from the market's behavioral fear, while essentially putting in a limit order to acquire a fundamentally undervalued, mission-critical asset if the price somehow drops further.
It's incredible how the options flow strips away the narrative. The volatility signals just give us a map of the market's true behavioral layer versus its actual physical constraints.
Yeah, they really do.
Okay, we have covered a massive amount of dense architectural ground today. Let's trace the full through line of what we've unpacked. We started by looking at the sheer physics of a $300 trillion market and how a 20% rally creates a $50 trillion collateral reality that essentially forces the government's hand.
Right. And we saw how the illusion of that government backstop distorts risk, causing managers to misunderstand correlations and leading to catastrophic leverage blowups.
Yeah.
Like the fund that thought it was hedged, but was actually just heavily leveraged on that singular AI factor.
Exactly. And then we looked at how cross-asset data reveals the physical truth of the market. The fact that a 72 basis point spike in real yields crushed gold but couldn't stop copper from soaring above $6.50, which proves that the AI capital expenditure supercycle is a physical reality that overrides financial gravity.
And finally, we decoded the derivatives market, showing how analyzing implied volatility and cross-asset leading indicators, like Meta's ad revenue predicting AppLovin's stability, allows you to basically exploit the gap between behavioral fear and fundamental strength.
It gives you a completely different lens to view your own portfolio. But as we wrap up, what is the ultimate takeaway for you listening? Where does this structural shift actually lead us?
Well, I think it brings up a really profound question about the nature of the market itself. We discussed the theory of the U.S. government potentially having to buy equities to manage its debt and short-circuit populism.
Right, effectively creating a massive U.S. sovereign wealth fund.
Exactly, to ensure that $50 trillion collateral machine never fails.
Yeah.
But if Western democracies ultimately decide they cannot politically survive the pain of organic market cycles and instead opt to actively buy their own equity markets,
Yeah.
what happens to the concept of a free market?
Wow. Yeah, if the government inherently becomes the ultimate put buyer for the entire S&P 500, does risk even exist in the way we've been taught to model it?
Exactly. Will traditional metrics of implied volatility simply cease to function as reliable warning signals for the everyday investor? Because if you know the house is mathematically forced to keep buying to prevent a collateral collapse, the entire architecture of financial risk has to be rewritten.
Right, because if that new player at the table, the state, starts changing the rules of probability as the cards are being dealt, then all the old models are dead. You aren't playing the fundamentals anymore, you're playing the behavioral psychology of the house.
Which is a whole different game.
It really is. Well, thanks for joining us on this deep dive. Keep questioning the consensus, and we'll see you next time.